My name is Brad Lowe. I'm one of the founders of Unlimit Wealth, along with Mike Schwally, Jordan Cole, and John Blaylock. The goal of Unlimit Wealth and our desire in creating Unlimit Wealth is to help educate our clients and you, the viewer, how to best understand the infinite banking concept as it was originally intended by R. Nelson Nash. We hope to help you understand how to best leverage your dollars to create future wealth for you and your family. You may say, what is infinite banking? Well, infinite banking is primarily about how we behave with our dollars. And the chief aim of implementing the infinite banking concept is to gain more control over the flow of cash that comes into your control. The more control we have over our own dollars, the more control we have over our own financial future. It's a common misconception in the investing, banking, personal finance world that the word savings and the word investing are commingled together to mean the same thing, when in fact they are two totally different buckets of money. When we talk about a savings bucket, we mean dollars that are safe, liquid, we have ready access to, hopefully that are growing, but we have a desired outcome for those dollars and we may need to access them sooner than later. When we talk about investment dollars, we talk about dollars that we're willing to take more risk with, which means we hope we have greater gain, but also means there's opportunity for loss. And those dollars are typically not as liquid and are going to be for the longer term. It's our belief that every dollar that comes into your hands is savings first. We have the ability to invest with the excess savings that we can create. So if we can be most efficient with our savings dollars and create excess, it means we have more opportunity to invest for the long term. Typically, we're taught by the mainstream to invest our 10 to 15 cents on the dollar of everything we bring in for our financial future. What if we turn that idea on its head and address the 85 cents on the dollar that we ignore? What if we could just capture a little bit of return on those dollars? Couldn't we then take less risk and get to our ultimate goal if we have 85 cents on the dollar working for us instead of just 15 cents on the dollar working for us? Let's have a quick lesson on life insurance. Most people are familiar with what's called term life insurance. You have a defined death benefit for a specified term of time, and that's typically the cheapest way that a family can get death benefit coverage. That's on one end of the spectrum. On the other end of the spectrum would be what's called single premium permanent life insurance. $1 in equals $1 of cash equals $1 of death benefit. That is a very efficient tool that up until the mid-'80s, the uber wealthy took advantage of by depositing funds there to have it sheltered from creditors and sheltered from taxes, still have liquidity, and to help with their overall estate planning needs. In the middle of that spectrum, you have what's called index universal life, variable universal life, whole life insurance. The further we move from term insurance down the line in the spectrum towards single premium permanent insurance, the more cash value we have access to relative to the dollar we've deposited. When talking about the infinite banking concept, we want to maximize the available cash that each of us have access to use to invest and take advantage of other opportunities. We do that by minimizing the death benefit relative to the dollar of premium that we've deposited. Instead of paying $1 for a maximum amount of death benefit, we deposit $1 for the minimum death benefit that the IRS will allow, where they still consider it life insurance, so that we get all the benefits associated with it. Think of it this way. Term insurance would be most akin to renting an apartment. You sign a lease, there's a dollar amount for the lease and a term of the lease. When the term of the lease is up, the contract is fulfilled, and if you want to continue to live in that apartment, i.e. keep the death benefit, you have to renegotiate the terms, get examined again for your life insurance, to continue to have death benefit. An apartment most times is cheaper than owning a home on a monthly expense basis, just like term insurance. Think of permanent insurance, i.e. whole life insurance, more like owning a home. You pay a mortgage for your home, and every month you build equity in that home where your equity rises closer and closer to the value of your home. With whole life insurance, when we make a deposit, your cash value grows closer and closer to your death benefit over your lifetime, and that cash value represents the equity in your death benefit, which is what we have access to as a living benefit while we are still here. When we design them for infinite banking, think of it like a home with a fixed mortgage and a fixed amount. If we pay the same mortgage payment for a home with a lesser value, i.e. the death benefit, we're going to create equity faster. That's what we want to do when we design infinite banking contracts for personal use. Create as much equity, cash value, as fast as possible. Most people are familiar with a HELOC, home equity line of credit. So that's a line of credit you can get on the equity in your home. Like most people understand, when you borrow against your home via HELOC or line of credit, that has no bearing on how the home value appreciates. The home doesn't recognize that there's a line of credit against it. The value of it's going to go up just like the neighbor's will or the guy across the street. It's going to happen the way it's going to happen. This is not dissimilar from how a whole life insurance contract works. The death benefit would be relative to the value of the home. The cash value would be the equity in the death benefit. The life insurance company will let us borrow against that equity to use it for whatever we see fit. But the policy doesn't know that there's a loan against it. It continues to appreciate whether you borrow against it or whether you don't. This is how the magic of compounding interest goes on in perpetuity when the infinite banking concept is utilized correctly. Think about the ideal place to save money. If we could create that, what characteristics would we even want? Obviously, we'd want it to be safe, right? We'd want it to be liquid. We'd love some tax advantages. We'd also love a competitive rate of return if we could get it. And if it's even possible, we would love it to be protected from creditors. But where do most people save money? At the bank, right? Savings accounts and money market accounts. Of those 5 characteristics, what do we get from a savings account or a money market account? We get safety and we get liquidity. Those are givens. Do we get a competitive rate of return? It depends, maybe, but we would hope to do better. What about tax advantages and protection from creditors? We don't get those. But think about a properly structured dividend-paying whole life insurance contract. Believe it or not, we get all 5 of those things we said we would want if it's structured properly. When we think about having access to more capital, one of the things that is most important to consider is what is the tax treatment of those dollars. A dollar of tax saved increases net worth by $2, $3, maybe even $4. Well, how are dollars taxed? What are even our options? We have 3 options, and that's it. They can be taxed, they can be tax deferred, or they can be tax free. So what are some examples of a taxable account? CDs, money markets, brokerage accounts, those are going to all be taxable. Well, what about tax deferred? IRAs, 401ks, SEPs, your business if you're a business owner, real estate possibly. What about tax-free? What are our tools at our disposal there? Most people are familiar with a Roth, but a lot of people, especially our high net worth people, don't qualify for that. You obviously could put it in the safe and it's not taxed, right? But it's also not growing. The third option in the tax-free column is properly structured permanent life insurance. Whole life insurance is what we like to use. If there was an asset in the tax-free column that in addition to being tax advantaged was also protected from creditors, completely liquid, not limited by our income relative to how much we could contribute, if that asset was properly structured dividend-paying whole life insurance, shouldn't we learn more about that? We are Unlimit, a group of wealth strategists that understand that your greatest avenue to creating wealth is to invest your time and energy in the things that you know and understand. We believe the best way for you to do that is proper use of the infinite banking concept. The infinite banking concept is a term that was coined by a gentleman named R. Nelson Nash. Mr. Nash wrote a book in the late 90s called Becoming Your Own Banker. Us here at Unlimit read that book in 2008, 2009, and unbeknownst to us, Mr. Nash resided in Vestavia Hills, Alabama, a suburb of Birmingham, Alabama, where we're located. We had the pleasure of studying under Mr. Nash from 2009 all the way to his passing in 2019. For his education and mentorship, we will be forever grateful.